Steve Leisman has the details on why today's read was important and what it means possibly down the line. Steve.
Hey, Dom, I like what you did there. You did the anchor thing, and then you did the reporting thing, and then you did the anchor thing again. I hope they're paying you a little extra, Dom. Anyway, after a string of disappointments, investors finally got a little relief on the inflation front, with the Fed's preferred inflation indicator coming in a tenth below expectations. But it may not be enough to stay the Fed's rate hiking hand. Here are the numbers. Headline up 0.3, and that's half the rate of January, so that was good. The year-over-year rate coming down 0.3 to 5%. The January core 0.3, a tenth better than expectations, lower than the January rate. And there's the core 4.6, ticking down just a little bit to 4.7. Now, income and spending, they did come off the blockbuster rates of January, but they sustained a high level, so that's going to be good for GDP. Oxford Economics, unfortunately, doesn't think it's going to last. They said, we think consumers will soon run out of runway as income growth softens, savings buffers fall, credit card usage lines decline, and inflation stays high. The trouble for the Fed here is that the core is falling only slowly, down less than a percentage point in a year. And the measure watched closely by the Fed chair, that core services ex housing, it was actually unchanged this month at 4.6%. So what happens here? The economy is still growing. Inflation is still high. You got the banking turmoil seemingly quiet for now. So the market leans slightly towards that May rate hike, with the probabilities 45-55 for that quarter point hike. But it does swing back and forth almost every day. So the banking turmoil, it continues to be the wild card here. Even if there aren't major failures, and that's what we hope happens here, tightening in credit standards will still threaten the economy, bringing down inflation, but also growth, and maybe replacing rate hikes for what I think, Dom, that'd be a lousy trade-off.
Okay, so Steve, if you look at this on balance, this is not enough perhaps to change the Fed's mind whatsoever, but is there enough of this in terms of the inflation narrative cooling off for folks to be a little bit more optimistic on what things look like in the economy going forward? I mean, the Fed rate hikes are supposed to be tapping the brakes on the economy. Has the economy slowed down or cooled off enough to make people feel a little bit more optimistic about the coming months for markets and the economy?
Well, here's the problem with all this, Dom. I keep describing this a bit like it's a wrestling match, and we're trying to pin down inflation. We keep counting 1, 2, and then the thing gets back up. And that's the way it's been. We keep thinking we're making progress, and the January thing was a real, game changer in the sense that not only were the numbers worse than expected, but they'd gone back and they revised up the prior numbers. So the inflation progress we thought we were making was kind of revised away with a couple, swirls of the pen right there. So, yes, it's 1 month, but as you know, 1 month does not a trend make. We did have the consumer slow down this month after blockbuster numbers last month. So all I can tell you is we have to wait and see and put a couple good months together. Remember, Powell has said he wants to have, substantial evidence that things are going the right way before he changes his tack.